Okay, let's unpack this. We are doing a deep dive into the Q3 2025 earnings call for GoodRx Holdings, ticker GDRX. This one hit the wires pre-market on November 5th, and look, it was not a clean quarter.
Not at all. And honestly, that's what makes it so fascinating to break down.
It's a classic two companies in one story, isn't it? You have this internal strategic pivot it's accelerating at a breakneck pace.
But at the same time, the structural headwinds in their sort of legacy business are still blowing really hard.
So that's the core tension we need to resolve for you.
Exactly. Our mission here is to sift through the transcript and figure out where the real, long-term value lies. We need to extract those core insights. It's all about balancing that explosive momentum in their new manufacturer solutions segment against the messy market turbulence in their old prescription business.
It really is about figuring out which trajectory wins in the end.
Yeah.
Okay, so let's start with the quick snapshot, the financial headlines.
Let's do it.
Total revenue came in at $196.0 million. Now, that was a slight beat on consensus estimates, representing pretty modest growth, 0.4% year over year.
A small victory, but in this environment, a critical one. The market got a little nervous, though, initially because of the bottom line.
Right, the EPS.
The non-GAAP EPS was implied at about 8 cents, which just missed the 9-cent consensus. GAAP EPS was a token 1 cent.
But, and this is a big but, this is where management showed some exceptional control. Adjusted EBITDA.
That came in really strong, $66.3 million, which gives them a very healthy 33.8% margin.
And that margin expansion is what got the market's attention, right? A 50 basis point improvement over last year.
It is. It signals some serious cost discipline and great operational efficiency. So despite that EPS miss, the stock actually saw a positive bump. I think it was 2.15% on the day of the call.
So the initial tape was positive.
Driven by the revenue beat, yeah, but I think more importantly by that underlying strength in the margin. That said, that enthusiasm, it kind of faded later in the week. It reinforces that the market is still, skeptical. It's locked onto the stability of that legacy prescription transactions business.
The PTR segment. If that can't stabilize, the market gets nervous.
That's the whole game.
And that segment divergence is, it's the true core of this story. Let's dig into those dynamics.
Yes.
The clear shining star, the new engine of this company is manufacturer solutions. Revenue there just exploded.
It was huge. A massive 54% increase year over year to $43.4 million.
And it's quickly becoming a much, much larger piece of the total revenue pie.
That 54% growth is the validation the market absolutely needed for the strategic pivot. It shows they can successfully monetize the pharma industry directly.
It's a whole new value proposition, moving away from just, aggregating coupons.
Right. But unfortunately, we do have to talk about the drag, that legacy prescription transactions segment.
The PTR segment, that's the core coupon business you probably use or are most familiar with.
Mm-hmm.
It saw revenue decline 9% year over year to $127.3 million. What specific forces were management citing for that?
They pointed to two primary factors. First, the impact of the Rite Aid store closures, which management did note are now complete.
So that specific headwind is fading at least.
It should be. And second, they saw lower transaction volume in their integrated savings program, the ISP, with one key PBM partner.
A PBM partner intentionally reduced its volume.
That's what they said, yeah, which also drove a decline in their monthly active consumer metric.
That's a huge nugget. Did they say why that PBM partner pulled back? Because that sounds like a serious friction point.
They implied it was driven by that partner's own internal strategy shifts. But what's fascinating here is how GoodRx is responding to it.
How so?
Well, management noted they are actively reassessing that monthly active consumer metric as a primary KPI.
They're saying it's less important now.
They're suggesting that as their business model shifts toward these high-value manufacturer-funded deals, the old volume-based metrics of the PTR business are simply less relevant to profitability. They're trading volume for margin.
Okay, that reframes things. And it puts their capital deployment into sharp relief. All this transformation costs money.
A lot of money.
So how are they funding this? They ended the quarter with $273.5 million cash on hand and generated $76.0 million in operating cash flow.
The cash flow generation is excellent. Total debt stands at about $496.3 million. But despite that debt, they are showing some serious capital discipline.
The share buybacks.
Exactly. They repurchased 13.4 million shares for $61.6 million during the quarter alone. They've still got $81.4 million in capacity remaining on that program.
That signals confidence, doesn't it? Both in their cash generation and in their own stock price.
It provides support as the narrative shifts. And despite all these headwinds, they reaffirmed their full year 2025 guidance,
which was total revenue of at least $792.3 million.
An adjusted EBITDA in the $265 to $275 million range. That projects about 2 to 6% year-over-year growth.
So they believe the growth segments are going to successfully offset the declines.
They do, but there was a critical note about Q4 that you, as a listener, really need to understand.
Okay, what was that?
Management explicitly guided for a sequential decline in Q4 total revenue.
A decline? That seems counterintuitive.
It does, but it's actually a sign of success. They explained that they pulled forward some major manufacturer solutions deals into Q3 to capitalize on seasonal spending. The true underlying health of that growth segment is better reflected by the robust 35% growth rate over the first 9 months of the year.
So it's a timing issue, not a structural one.
That's the argument.
That clarity helps a lot. Okay, so let's talk strategy. That explosive 54% growth in manufacturer solutions is being driven by this focus on D2C enablement, right?
Absolutely, especially in the most expensive non-covered areas like GLP-1 medications.
The weight loss drugs.
Yeah. The biggest headline was the collaboration with Novo Nordisk to offer Ozempic and Wegovy at a direct-to-consumer cash price of $499 a month.
That's targeting the millions of Americans who are locked out because their insurance just won't cover weight loss.
And GoodRx is positioning itself as the critical bridge to affordability in this massive, massive emerging market.
That $499 price point is bold. What did management say about the margin on that compared to their old coupon business?
I mean, that's where the high margin infrastructure story really lives, right?
Exactly.
They didn't give precise numbers. But the implication is that these D2C programs are significantly higher margin and higher value than the pennies they earn on traditional prescriptions. They now manage over 200 brand affordability programs. Nearly 80 of those are pure cash prices.
Like the Amgen Repatha deal.
Right, where they facilitate a deal offering nearly 60% off the retail list price. They're transforming from a coupon source into essential digital commerce infrastructure for drug manufacturers.
And that infrastructure is becoming physical too. This whole idea of owning the pharmacy counter.
Yes.
They announced the expanded rollout of their RxSmartSaver counter solution across all 2,200 Kroger pharmacies nationwide. That's a huge integration step.
It is. I mean, think of it this way. Instead of relying on you to remember to show your phone app, the system is a turnkey solution that's hardwired into the pharmacy workflow.
So it's right there for the pharmacist.
It gives them instant access to GoodRx savings, manufacturer copay cards, right at the point of fill. It streamlines everything.
Yeah.
And locks the patient into that savings pathway.
And they also extended this to the little guys, right, with Community Link.
Yeah, that's a new cost-plus pricing model designed specifically for independent pharmacies. It offers predictable pricing, better economics for those smaller businesses that just can't compete with the PBM giants.
And what about the subscription business?
That's evolving too. It's moving beyond just the Gold program. They launched GoodRx for hair loss using their new e-commerce platform.
And they're planning one for weight loss.
A third one, yeah. The idea is to bundle the GLP-1 savings programs with their e-commerce platform to build these sort of integrated end-to-end digital experiences.
So they keep the customer inside the GoodRx ecosystem no matter what their insurance looks like.
That's the plan.
This whole move toward building integrated infrastructure, it explains why they're talking directly to Washington. Let's shift to the political and regulatory landscape.
This is really interesting.
Management confirmed they are in active architect-to-architect engagement with HHS to integrate with the emerging federal D2C pricing platform.
Sometimes called Trump RX.
Right. And that phrase, architect-to-architect, is key, isn't it? It means they're involved in the foundational design.
It does. Management is positioning GoodRx not as the fulfillment engine, they aren't shipping the pills,
Sure.
but as the trusted repository and conduit for cash pricing information.
Their argument is that because they enable the actual cash transaction at pretty much every pharmacy in the country, they're uniquely positioned.
It's a differentiator against smaller competitors who are limited to just, home delivery partners. They want to be the essential data layer.
And if we connect this back to the bigger picture, the whole PBM evolution discussion was also very revealing.
Mm-hmm.
Management said they applaud the shift from the traditional rebate model to point-of-sale discounts. But is this genuine support? Or are they just happy because it validates their whole business model?
I think it's both. They definitely see it as validation because, I mean, they're already operating as the cash engine for comparative pricing. But critically, they argued that this shifting regulatory pressure on PBMs creates long-term structural tailwinds for GoodRx, especially looking ahead to 2026.
Okay, what are those macro tailwinds they're counting on? It sounds like they're betting on the American patient feeling more financial pain.
They are. Management believes 2026 will see a reversal of the 2025 PTR headwinds.
Driven by what?
By rising out-of-pocket costs and increasing financial pressure on consumers. They cited data suggesting premiums are rising, like the 33% increase in CMS Part D.
And out-of-pocket costs could go up 25 to 100% for some patient groups.
Exactly. And crucially, they expect potential ACA or Medicaid changes could increase the number of uninsured or underinsured Americans.
All of which dramatically expands the cash market.
Which is GoodRx's sweet spot.
And that leads us right back to their marketing spend, which is still running high, around 40% of sales.
And management fiercely defended this investment. They pointed to the success of the Savings Wrangler brand campaign.
What metrics did they give?
They said key metrics like unprompted awareness and just pure GoodRx search volume are up significantly.
So they're spending money now to preemptively lock in market share and brand recognition.
That's the bet. They want to be the default choice for the millions of consumers who they expect will enter that expanded cash market in 2026.
That emphasis on preemptive market share really frames the whole quarter as an infrastructure investment period, not a maturity phase.
And now, as required by law and tradition, we transition to our segment. This is not financial advice.
Right. But let's pitch an outrageous but plausible trade idea based entirely on this earnings call narrative.
Let's hear it.
The core thesis is this. The market is hyper-focused on that contracting, low-margin legacy PTR business, the one that's down 9% year over year.
And it's therefore severely undervaluing the explosive, high-margin manufacturer solutions segment, the one that's up 54%.
So the trade, targeting those predicted 2026 macroeconomic tailwinds, would be a paired trade.
Okay.
You would short the legacy PBM-dependent pharmacy retailers, the ones struggling with the changing economics, closing locations.
And you'd simultaneously buy GoodRx.
This is explicitly betting on the long-term structural shift away from traditional insurance and PBM friction at the counter.
So you're betting that the D2C enablement layer that GoodRx is rapidly building,
the RxSmartSaver, the GLP-1 programs, Community Link,
will be the technology that disproportionately rewards them when that highly leveraged cash pay environment forecast for 2026 finally arrives.
That's the trade.
So what does this all mean for you? Q3 really confirms the story of two companies in one stock. You got strong, profitable execution in the new manufacturer solutions segment.
And that's successfully offsetting the structural pressure on the core prescription business.
The result is a positive, long-term mix shift story that management is actively guiding you toward.
And the final provocative thought for you to mull over is this. Given management's aggressive engagement with new federal policy like Trump Rx and the massive investment in GLP-1 D2C programs, is the company fundamentally transforming?
Are they going from a simple coupon aggregator into essential pharmaceutical infrastructure, a necessary conduit for manufacturers to reach cash pay patients?
And if so, how does that fundamentally change its valuation multiple as we head into 2026?
If the answer to that is yes, we are looking at a very, very different kind of company than the one the market is currently pricing. We'll catch you on the next deep dive into the numbers.